Hey guys, welcome to the Tony Denaro channel. Today we're going to do a lesson for beginners on options. What are they? Basic definitions. There's going to be a whole series about options. Later we'll get into technical analysis, some day trading videos, and eventually crypto. We're going to start off with options. Again, if you're a beginner at options or have never traded them before, this video is for you. Be sure and check out the entire series, which we'll be posting over the coming days. Today's going to cover the very basics. First of all, what is an option? An option gives you the right, but not the obligation, to buy or sell a stock at an agreed upon price called the strike price on or before a date called the expiration date. Why would you want to trade options? Options are useful to experienced traders for a couple of reasons. Hedging, used as a risk reduction strategy, or for speculators, used as a low-cost method to go long or short a stock, or even an index without having to come out of pocket to buy the stock itself. The two basic types of options would be a call option or a put option. Call option is used if you are bullish on a stock. When you buy a call option, you're paying for the right to buy shares at a fixed price, the strike price, on or before a certain date, the expiration date. A put option is used if you are bearish on a stock. You expect it to go down. When you buy a put option, you're paying for the right to sell shares at a fixed price, again, the strike price, on or before a certain date, the expiration date. Now let's talk about some other basic definitions before we can get into the next lessons. First of all, what is the strike price? What is the expiration date? The strike price is also known as the exercise price. It is the price for which the underlying stock can be bought or sold. This is the key determining factor in an option's value. The expiration date is the last day that the options contract is valid. You must decide what to do with your option on or before this date. After the expiration date, the option will expire worthless. The final basic definition is the option premium. Now, when you hear us talk about premium, it means the current price of the option. Understanding options premium. An options price or premium consists of two components: the intrinsic value plus the extrinsic value. The intrinsic value is the difference between the underlying stock price and the strike price. Extrinsic value is the difference between the price of an option and its intrinsic value. For example, intrinsic value. If we're looking at a stock that's $25, you're looking at a call option with a strike price of $15. It has a $10 intrinsic value. If the call option costs 12 bucks, there's an extra $2 of extrinsic value. If you're looking at a stock that has a price of $10 and you're looking at a strike price on an option of 15 bucks, there is zero intrinsic value. But if the call option costs $2, there is $2 of extrinsic value. I know this is confusing. We'll get into it more in additional lessons. Today we're just going over the basics. Feel free to pause, rewind, and watch again. One more thing about extrinsic value. It's composed of two components: time value, which is the time left until the options expire, and the implied volatility, often what we call the IV. The implied volatility is simply the likelihood of changes that the market expects in the underlying stock's price. Final definitions that you often hear when it comes to options are in the money and out of the money. An option is in the money if it has intrinsic value. In other words, the strike price is favorable compared to the underlying stock price. Here's an example. Stock price, 20 bucks. Call option strike price, $15. That means that the option is $5 in the money. An option is out of the money if it only has extrinsic value. In other words, the strike price is not favorable compared to the underlying stock price. An example would be if you're looking at a stock with a price of $20, the strike price is 25 bucks. It's $5 out of the money. Now that's not necessarily a bad thing because out of the money options generally cost less to buy. Let's go through a quick example of buying a call option, and we'll get more into this in lesson number 2. Pretend today's date is January 1st. We're looking at a stock XYZ who has a current price of 90 bucks. We're going to buy one call with a strike price of $95, expiring the third Friday of February 18th. Buying this option gives us the right to buy 100 shares of the stock at any time prior to February 18th for 95 bucks. What happens if the stock goes to 100? Well, we have a difference between $95 and $100, $5 per share, or you'd be looking at a $500 gain. Buying a put option, here's a quick example on that. Again, we'll go more into that on lesson number 3. If you are bearish on a stock, you'd buy a put. If today's date is January 1st, current price of the stock is $90. We'll buy one put with a strike price of $85 because we're expecting the stock to go down. This put gives us the right to sell 100 shares anytime prior to February 18th for $85 per share. If the price plummets, let's say it goes to $80, one put is equal to 100 shares. We've got a difference between the strike price and the stock price of $5 per share, or again, a $500 gain on the put. This lesson was a very quick one just to go over basic definitions and a couple of brief examples. I promise you on lesson 2 and lesson 3 on call options and put options, I will explain how to use these, when to use these, and exactly what's the difference between buying a call option versus buying the stock. What's the difference between buying a put option and selling the stock, or why would you want to use a put option as insurance to insure a position that you have in your portfolio? Each one of these lessons is going to be kept short so that it's in easily digestible chunks for you. I will see you on lesson number 2, where we go into more detail about call options. Thank you for watching. I'm Tony Denaro, and I will see you on the next video.
So you wanna go to war?